Welcome to Subramani. I am going to talk about something which people may not want to hear, but I think going forward equity returns will go down. Bond returns, the gap between equity returns and bond returns will come down. The return from small cap fund and mid cap fund and the large cap fund, the gap would again come down. What am I really saying? If you were investing in the 70s, 80s and maybe even in the 90s, getting adequate information about companies was very difficult. So you had to go sit with the CFO and he will tell you things, then you had to find out whether he's speaking the truth. All that would take a lot of time. Sometimes the promoter would say nice things, sometimes the promoter would say bad things. Sometimes the promoter would actually want to beat the share price down so that he could come out with a private offer. So you didn't know how much to trust the promoter, how much to trust the CFO, or how much to even trust the analyst. There have been journalists who have bought the membership in Bombay Stock Exchange and Bombay Stock Exchange, the price of getting a membership was as high as when I heard the highest price that I heard is 4.25 crores. So you knew that somebody was in the take. There was rampant insider trading. Information was far more difficult to get. Before the internet, there was no way how you could have got any of this information at all. Yes, there were companies, I remember Vans, which is a value-added news service, who used to give data collated, properly put, but all that is in the later stages. Earlier, we had to do our own newspaper clippings, cuttings, stick it in files, and then remember to whether company had to be stuck in cement or stuck in promoter, give cross references, make photocopies. Collecting data was extremely difficult, extremely painful and very, very labor intensive. You had to go to every nook and corner, what we call the Raddiwala, the waste paper guy, who would pick up balance sheets and keep it for me, and I would say, Achha, I want these balance sheets, and he would charge maybe 2 rupees, 5 rupees, whatever, I don't remember. So that is how you got information. There was no website where you could go and download and things like that. So you had to sit and calculate the ratios, and when the ratios were dramatically different from what you thought it was, you had to recalculate to see whether you made a mistake, because you were using computers, yes, Excel, but you didn't know whether you put the right numerator, right denominator. So you have to go back and track and make sure that you were not making too stupid a mistake, or the CFO or the promoter would just rip you apart. So we had to do all those things. There was one huge advantage, of course. There was no media throwing things at your face on a regular basis. Newspapers were considered expensive. I remember Economic Times used to be 5 rupees or 7 rupees. And then later on, because of advertising, they dropped it to 2 rupees. But earlier, Economic Times was expensive. So Economic Times, Financial Express, Business Standard, you picked up 2-3 papers, read them, see what was being said about companies. All that was necessary, and all that was time consuming. Therefore, you could also monitor lesser number of companies, maybe 20. You could not monitor 500 companies the way today you can if you want to. So the getting information was difficult. Getting research reports was almost impossible. You didn't know how much of bias was there. You didn't know enough about internationally which stocks you had to compare. And even if you knew what to compare, let's say I knew that I had to compare General Motors, Toyota and Tata Motors, let's say for starters. I had no clue how to get those balance sheets in electronic form so that I could compare the three. Now, if I got the Toyota balance sheet, I had to make sure it is in English. I had to make sure that I got the General Motors, and then I got Tata Motors. It would take a month to start doing the analysis, right? Waiting for these reports to come in. Today, life is very different. Also, what happened is when somebody tells you that small cap is giving you greater return than the market return, than the broader index, or that equity funds are giving 4% more than what bond funds are giving, you need to understand it is just compensation for risk. At the beginning of the transaction, you didn't know that the small cap is more risky compared to the large cap. And therefore you are being compensated. You never knew that why you were being compensated, but you knew that you were being compensated. So similar, but today what can happen more and more people can know, will think that the small cap will give better returns than large cap. So more and more people will enter small cap, which itself will depress the return in small cap. And more people have ignored large cap, so the returns in large cap will go up. So the gap between mid cap and large cap, or between small cap and mid cap and large cap, will narrow down. Also, you will be able to put enough money in, say, credit risk or credit opportunity fund, because there are enough number of investors coming in. Maybe the number of investors who are coming into the market today is, say, 10 times more or 5 times more compared to what was happening in the 90s. Or even in the 80s or 90s, but I don't have enough data to prove either ways. I can't say more number of investors have come in, because one thing which has happened is there are definitely more number of traders, and they are doing bigger quantities, right? So we never dealt with these kind of quantities. Today it is easy to see people trading worth a few crores in a few hours. For us it was unthinkable. Those kind of volumes we had not seen when we were investing. Now, given all that, because the risk is gone down, because information is available, mutual funds are available, diversification is possible. You can put, say, 20% of your money in small cap fund, 20% of your money in mid cap fund, all of the equity portion that you have. I would still recommend a higher portion in large cap fund, but yes, it is possible for you to find all that. It is possible for you to invest in mutual funds and reduce the risk. It is possible. Once upon a time, you just bought shares and hoped that it was right. You didn't, at least I never bothered to find out whether it was a large cap or whether it was mid cap. I just went, bought those shares, and I kept it for a long period of time. Companies like Hero Honda moved from small cap, or rather maybe mid cap, to large cap, to mega cap, and then I held through that. So we didn't mind going from small cap to mid cap to large cap, because we had more patience perhaps. Now you have more data available, or at least more data available. How to convert it into information is up to you. You also have information available for a price. You can buy research reports, you can commission research reports, all those things are there. So the data availability is better. Maybe the price discovery mechanism is better. So which means if consistently you see that small caps are giving better return than mid cap, lot of money will move to small cap, and therefore the returns and results could be a little more depressed. So I think going forward, the gap will go down, the amount of return that you get in debt will go down, therefore the amount of return that you get in equity will go down, and therefore the amount of return that you get in small cap funds and mid cap funds will also go down. Will the gap remain between large cap and mid cap or small cap? Answer seems to be yes, but it is possible that we will overdo, and therefore we will put more money in small cap. So small cap will see larger drawdowns, which is very scary, because more and more people will get out. So if you are in an open-ended scheme and you don't get out, still the fact that some others are getting out will depress your returns because of the losses that the portfolio will take in selling distress. So there is enough argument on both sides to say you should put money in small cap, but you need to understand that small cap is giving you better return than large cap, simply because they are paying you a higher risk premium. So if a company like a Tata Group or a HDFC Bank wants to borrow money, they may be able to get it 7%. However, a company with lesser reputation may have to pay 9% or 10%, whatever. That is called the risk premium. So will the risk premium disappear in small cap? No. Will it disappear in mid cap? No. But chances are overall equity returns will be lower than it was in the past, and index funds will ensure and make sure that people have adequate risk reduction mechanisms. So all these things in place will make sure that the return that you think you should get, or the return that you are getting in small cap and mid cap funds, will go down. You may need to diversify into international stocks, you may need to diversify into gold. So you may start looking at, or you will and I will start looking at multi-asset allocation funds, simply because we need that extra US return or China return, etc., 20-25% in our portfolios. And that will happen through a more tax efficient method of doing like the MAA, rather than trying to do it yourself. But should you lower the expectation? Answer is yes, you should lower the expectation. Lower expectation means what? What is the implication? The implication is very simple. You need better diversification. Maybe you need international stocks. Maybe you need more gold, whatever, all that combination. And you will have to save more, because somebody else saved less but got a 13% return or a 14% return. You should not use that example. You should tone down your expectation, and for toning down your expectation, we need to save and save more, and then use that and invest more. Thank you.